Hi everyone, this is Rohit from Lifestyle Mastery, and today I'm excited to have Sergey Gribov, who's a partner at Flint Capital, which is an early stage venture fund that invests across Europe, Israel, and US with 19 exits and 3 unicorns in its portfolio. Welcome to the show, Sergey.
Thank you. It's fun to be here.
Awesome. So you have an interesting journey, and you do invest across different markets. But I was interested to know, how did you get your start in this crazy world of VCs?
So my original background is technical, and I guess I was lucky. I was employee number one in one of the successful startups from Israel, right out of university. Actually, I was still studying in university, so I had to do a lot of different things. The good thing about being employee number one, like really crazy growing companies, you can do bunch of different stuff. So that's how I moved to US, basically to open our office in US. And I was involved in startups all my life. I think during my whole career, I worked for a big company about 2 months, was
Yes.
bored to death. So at some point, I was being part of a bunch of different startups as kind of technical management / founding team. At some point decided kind of to switch to the dark side, went to MIT, did business degree, started to do some angel investments, and joined Flint about 8 years ago as a partner.
Interesting, and you said something very interesting, which is you've always been into startups, and so have I. I've been into tech startups, but I do get a lot of a pushback that why I haven't worked in a big company. Who do you think should work in tech startups, because it can become really hard, especially in 2023. You don't want to be in a tech startup, but who do you think is an ideal startup guy, and how should somebody make a decision that they should work in a bigger company or they should work in a startup?
So I actually got this question from time to time from friends, should I go and join some startup? And my take on it depends on personal preferences. So people who comfortable with like a lot of ambiguity, a lot of unknown, they will feel great in startups. It's like basically startups are about to take risks, and frankly, I always envy all the founders who invest in, because these people are taking huge risks. Usually, the chances of startup to succeed are actually pretty slim. And even if you join as employee at startup, you still need to be able to kind of cope with this risk, because sometimes you have a company who have like several months of runway, and you basically don't know if a company will exist in 3 or 4 months. But from another side, it's bigger risk and bigger rewards. So in startups, you can build your career way faster than in big company. If a startup is successful, you grow with the startup. So I think it depends on the person. If a person is really comfortable with a lot of unknown and a lot of risks, I would say it's certainly worth trying startups. I would guess for somebody who is young and willing to take more risks, it's probably a good idea to go to startup. From another side, if some people are really uncomfortable, then they don't know what's going to be in with the company in like 6 months or a year, yeah, maybe it's better fit for them to work for bigger companies. So it's not like startups are good or bad, it's more like personal fit.
I see. Very interesting. And especially, you work in tech startups, and then you moved on to Flint Capital. And very interestingly, you also happen to be the board member at Unicorn, startup called Socor. How did that come into picture, and how did you get to invest into Socor, which went on to become
Yeah.
$4 billion company?
Yeah. So Socure is a fintech, basically virtual identity company. Their mission is to verify 100% of real identities on the internet.
Right.
I led the around. I met with the company through a couple early investors in the company. You know, a lot of these things happened kind of half accidentally. You talk to different people. You ask them what interesting companies in your portfolio I should meet, and that's how I got to Secure. I really like what we were building because it was unique. There was really cool technology behind it. It's basically a data science company. Even now, when the company is really big, about a quarter of people in the company are data scientists. So I led the around help company to grow through different rounds, and I think I'm probably the oldest serving board member there right now, because most of our board members joined company later on. But it's been and it's still a really fun ride. It's really great to see the company kind of getting from like really early stage company with just 20, 30 people to pretty big and serious company.
Quite interesting, and especially since you've been a board member of I would say around 8 startups. What does good board membership require? Especially when it comes to early stage startup boards, they can only compensate you with equity, but what does it take to become a good board member?
So yeah, so one we not when we represent fund, you usually not compensated personally. Basically, we kind of we invest in a company. If we lead round, we usually join board,
right?
And you kind of represent your fund, and a little bit broader, if you like. For example, in case of Secure, I represent A and C preferred. So everybody who invested together with us, I kind of represent them. In different stages of a company, it's kind of a little bit different. I think, and what goes to general question of how like VC can bring some added value to startup, because like when we're competing for good deals, usually startups have a bunch of term sheets on the table, and we have to choose which investor we would go to. So everybody is talking about like value add, because like if you think about money is kind of ultimate commodity. It's all green, so it doesn't really matter if it's dollar from me or dollar from our VC. So what I found is what everybody is talking about different value adds. I'm kind of lucky in Israel ecosystem because everybody knows everybody. So basically, when people ask me about my value add, I just say, okay, what I can promise you, I'll try to help. In some of my companies, I was able to help to bring really good sales leaders. Does it mean I can do it in any of my companies? No. In some of my companies, I was able to connect them to good follow-on investors, but does it mean what they will invest? No, sometimes we would, sometimes we wouldn't. What I can really promise is I'm going to try to help in any shape or form I can. So especially with early stage founders, and especially with like first time founders, that's actually a very important thing, to be there for them and trying to help in many cases, which means basically just being like sounding board, or in some cases even being kind of a shrink to founders, because being CEO is a very lonely job and you can't really talk to your like VPs about like really all the problems you're going to. So sometimes you would talk to your board members or your investors if you have a really trusting relationship with them. So it's in the early stage, you're trying to help company to set up boards, and basically I work a lot with like first time founders. So in some cases We don't even know how the board should look like, how the board presentation should look like, etc., etc. So I try to work with them, kind of trying to slowly shape them in a way what then there will be time when they need to raise the next round and we're going to go to follow on VCs. When VC look at the board meeting minutes, the board decks, we could see what the company is actually matured in terms of like operations, in terms of management, etc. Later on, you're trying to help them bring the next investors on and trying to help them maybe to navigate how do you communicate with investors, things like that. So basically, you're trying to be there for them. And what I love about it, like good entrepreneurs, you start working with a first-time entrepreneur and we don't know how to do a lot of this stuff, but fast forward a couple of years and you can see what we actually very they're growing with the company, so they can actually do pretty much everything by themselves without your help. So you kind of you try to help them to get there, and they growing with the company, and you being there basically for the ride at some point.
Yeah. Interesting. And is there any difference from an early stage, board membership and to later stage? And what could be the differences there?
Yeah, there are a lot of differences. In early stage, usually boards are way less formal. Usually don't have that many people on the board, and you kind of talk. You have way less issues, so you can kind of you have shorter boards. Later stage, usually you have like you have to go through procedures. Usually at a board you bring your management to the company, which sometimes can be like a bunch of different people. You bring all your VPs, etc. So you have way more structure to the board. You need to make sure you can cover everything. You have way more things to discuss. So it's usually more mature, more structured. Different questions, like at early stage, you can discuss a single hire. Basically, at later stages, you're already not at the stage when you're talking about a single hire, unless it's like C-level executive, because people are hiring like tens of people a month or a week even.
Right. Interesting. And I think the most interesting thing, what I've realized is like Israel is such a small country, but there's a high density of startups, and I think the highest number of unicorns per mile. I don't know, but why do you think Israel has so many, a number of startups, and they're doing so well, considering that it is, it's not in the epicenter of Europe or in Asia or in the US.
So there are lots of information about it, and it's probably a longer conversation because you have complete puzzle why it's happening. There is a good book called Startup Nation, which discusses it, but it's combination of many different things. It's combination of culture. In Israel, it's kind of a culture, basically, never ask for permission, ask for forgiveness. Basically, people are just doing things and we'll see how things fall. And also, because of all the army, everybody goes to the army there. So if you take like 24 years old Israeli versus 24 years old American, the average Israeli at that age would be way more mature because the person would go through the army, had some leadership training. In many cases, they would be an officer in the army, and they had like very serious responsibilities. Plus, you also have all these cyber units, which are actually very good in teaching people computer-related skills. So, army is a big portion of it. Also, I think one of the interesting thing in Israel, the country is small, so nobody really thinks there is any market for their startup in Israel. So they had to go global from day zero. And basically, most of Israeli startups, even at the initial stage, are already going after US market, which I think works really well there. But on top of it, it's also it took 20 plus years for the ecosystem to develop to the stage it is now. When I first started in the first company I worked for, it was like mid 90s. Sorry, Israeli ecosystem was just starting, so there were not that many people in Israeli ecosystem who knew how to sell in US. Usually, Israeli startup would develop technology and sell it early on to US companies. But nowadays, you have a bunch of unicorns, Israeli startups buying other Israeli startups. So the whole ecosystem is a completely different level. But it took time, and it took a lot of learning and experience from like everybody around the ecosystem.
Very interesting. And another interesting thing about your experience is that you're part of a team which bought a company called Vivox, and then you sold it for 20x return. Why did you go on to buy this company, and what were your lessons building the company?
So Vivox is an interesting case, and I think at some point I should probably write a business case on it, because it's actually a case how VCs can screw up the company, but what happens all the time. What was unusual, what at the end, the company, we did a management buyout, and kind of it was very successful management buyout, basically. Well, I was actually part of founding team at Vivox. It was, I think, 2003, 2004, I think, when we started Vivox. Company got 20, I don't remember exactly the number, but more than 20 million from really good funds like Benchmark, Canyon. The problem was what the company was doing, voice communication for like online games and stuff like that, where you can build a nice company, but you can't really build $1 billion company in that space, at least at that time. And the problem, when you raise too much money from VCs, they kind of push you to go big or go home. Right. So I left the company when I went to MIT, and basically I was doing some other stuff afterwards. Fast forward like about 8-9 years, and you see the company which was doing like about 3 million in revenue, cash flow zero kind of thing. Funds were at the end of their life, so they weren't interested in doing anything with this company. And it's a good, we're talking about great funds, so for them, like a couple millions wouldn't make any difference. So I participated, basically we did management buyout. We bought a company back from VCs for 3 million, allocated, I don't remember, 30 or 40% ESOP to kind of properly motivate all the team. And the company grew organically since then, grew to about 10 million in revenue, and was sold to Unity for 100 million, which was a great investment for everybody. It was great for the team, which made a lot of money. It was good outcome.
No, I think that's super interesting. And since you work with a lot of founders, what do you think are some of the traits which some of the special leaders have, especially with the unicorn founders?
There are a lot of different things. You look at, especially the unicorn founders, the very successful founders. They usually have really great vision, and they stick to that vision. I think like one of the things I learned working with a lot of different founders. So you have kind of scale of things. You have on one side, you have founders who would listen to everything you say, and would do whatever you say. On another side of the scale, you have founders who wouldn't listen to anything you say, so they wouldn't listen. So the great founders are somewhere in the middle. They would listen to all the input from everybody around the table, but they would make their own decision. And sometimes they would agree with you, sometimes they wouldn't. And it's their choice. So I think the great founders, they have vision, they have this ability to listen to everybody around them, but make their own decisions, sometimes make hard decisions, and also lead by examples.
Correct. And how important do you think is, the speed of execution during these times, especially in 2023, where there have been a lot of layoffs and, a bit of a capital crunch, but how important is, execution and the speed of execution for founders?
And execution is always the most crucial part, because like ideas are kind of, people say a dime a dozen.
Right.
Execution is everything. I wouldn't put it as speed of execution. I would put it as execution, because sometimes you need speed, sometimes you need to be smart about speed. Like, I think one of the big problems which we saw in like 21, 20 and beginning of 22 is people would raise way too much money and they would burn it way too quickly. So they would say, okay, we need to be fast, so let's burn as much money as we can and basically get results. And a lot of these companies are going to get either already getting screwed or going to get screwed, because a lot of people nowadays are looking, if in 21 everybody was looking at like revenue numbers, today people are looking at capital efficiency.
Yeah.
So being capital efficient doesn't always mean you need to move fast. Sometimes you do. Then you understand what, okay, you have product market fit and you have a scalable sales model. At this case, you can already move fast. Basically, you can put more money into marketing and sales and you're going to deliver results. But until you get to this product market fit, you still need to move. You need to move fast, but you need to iterate fast. You can't really burn too much money. There's no point of trying to spend too much money in marketing until you figured out your product market fit. So in that sense, you have to move fast in terms of like interactions and getting to product market fit. But that would be a different kind of moving fast in essence. So I would say you need to have great execution, and sometimes it means moving fast, sometimes it means interacting fast but not kind of growing that much yet, because you need first to build this product market fit in order to start growing.
Got it. Interesting. And how important do you think is mission statement and vision? Do you think it's really relevant, especially in the early stage, or do you think that should come much later after the product market fit has happened?
So I think it's important to have vision, because
Right.
basically that's kind of that's where you're trying to go, and it's okay to pivot along the way, and it's okay to maybe even change your vision, but you need to have something like far on the horizon where you're kind of trying to get to. Otherwise, you just doing too many interactions and kind of going in circles.
Got it. And what do you think is biggest lessons for you when it comes to delivering feedback, not only to the founders and when founders are giving that feedback to the employees?
I think in giving feedback, it's very important tool. I think the good feedback comes with a trust.
Right.
Because it's not very useful to give very nice feedback just because you want to be nice.
Right.
You need to give constructive feedback, and it doesn't work well unless you already have enough of a trust, and it takes time. Basically, it takes time. People need to understand what the feedback you're giving is useful, it's actionable, etc., etc. It's not like you haven't done any feedback during 2 years and suddenly you start giving feedback and everybody takes it seriously. It's something you build over time. And when you have this trust, it's very useful to have very constructive and honest feedback. I think it's hard for many people, but when it's actually working, it's huge plus.
Got it. And where do you see is the biggest mistakes founders make when they are delivering feedback to the product guys or to the revenue team?
So in many cases, it's hard to give honest feedback.
Right.
And in that respect, I actually love working with Israelis because Israelis are very direct.
Right.
I've heard from many American investors, for example, when we talk to Israeli founders, we a little bit kind of taken aback a little bit by directness, because Israeli founder is not afraid to tell you what you're full of bullshit if they think so,
Right.
Which I love. And I think when, for example, founder give feedback to their product team or their marketing team, it's important to be honest, and it's important to be constructive. It's important not just to say, okay, I think whatever the marketing campaign we did, it didn't work, and basically all your ideas sucks.
Yeah.
That's not useful feedback. The useful feedback would be, okay, let's take a look at the numbers. It doesn't look from the numbers we hit what we wanted to hit. So there is a problem here. So let's think together what we can change. What's your ideas? What can be changed, etc., etc. So it's pretty much the same type of feedback, but it's completely different in terms of how it's delivered. It have to be something constructive. It have to be something what people can take and do something with.
Right. And you had earlier alluded about I think secure being one of your biggest hits, but what's been your biggest misses, and what did you learn from some of the biggest misses which you were not able to invest in?
We at Flint, basically, what we do from time to time with 3 partners, we're very small investment team, 3 partners, 2 principals, and the whole team is completely remote.
Right.
We distributed between Boston, Europe, and Tel Aviv.
Right.
So we try to, at least between 3 of us, we try to meet at least every quarter, and one of the exercises we're going through, we're trying to figure out what's worked, what didn't. So sometimes we would look at our prior investments and would think through, okay, if we today would know exactly the same things we knew back then when we decided to make an investment, would we invest today? Not knowing what happens afterwards, but given all the information we had back then. And one of the lessons learned, which we see pretty much every time, I would say probably 80 to 90% of the time, the problem was team, the founders, the team of the project. So, and it's different. Sometimes it's team just didn't have enough expertise to execute on their vision. Sometimes actually it's about team being able to listen for the feedback. So as I said, the best founders on this scale, from being able to listen and doing something, doing everything we told to like our side, not listening to anything. We're great founders are somewhere in the middle. We should be able to listen for feedback and make their own decisions. So sometimes we invested in founders who were on one side of the scale or another, and in both cases it didn't work well, for example. So I think 80 to 90% of mistakes we did, we did as when we invested, were related to actual team of founders, people, etc.
Interesting, very interesting. And where do you think, what the biggest mistakes VCs made from 2022? Do you think VCs made a lot of investments and now there's a bit of a hype and now they're trying to save some of the startups?
Yeah. So what happens in 2022? It was way too much money on the market. In essence, it's economics 101. You have supply, demand. Supply are startups. Demand is money. Like you can take dry powder at VC. And what happens in 21 and beginning of 22? You had way more money than previously. I don't remember the exact numbers, but if you compare to amount of dry powder in 21, it was probably almost twice whatever was available in like 18 or 19. So the number of startups were pretty much the same. It's not like people were starting twice more companies. So you had way more money chasing after the same number of startups, and as in usual supply-demand curve, the prices skyrocketed. So valuations were really high, and a lot of people were kind of, okay, I have to invest, even if I don't like valuations. If I'm investing with this valuation, or I don't invest at all. So people continued to invest. And frankly, a lot of valuations were completely outrageous. So the problem a lot of these companies will have, especially if we're talking about companies who raised like seed rounds in 2020, 21, 22, their valuation was really high. They are coming now and they need to raise their next round. A lot of valuations came down. I haven't seen like good statistics on that, but from what I see, from what I hear, right now valuations are getting back to like normal level of like somewhere between 2017 and 2019 levels. And what happens, what all these companies which raised at valuations which were completely unreasonable, we come into the next round, and a lot of these companies, even if it's good company and we made some progress, we still not gonna justify the up round from the early round valuation. So a lot of these companies are gonna get screwed because they will have to do, in the best case scenario, flat rounds, and in most of the scenarios, we will have to do down rounds. It's always hard. As an investor, it's much easier to decide to do up round if you see it's reasonable than to go in and say, okay, the company is good, but valuation is just out of whack, so let's do down round. You're going to screw up common, which are founders and employees of the companies. You're going to probably have to screw up early stage investors, and nobody wants to do it. So to raise a down round, it's much harder to raise a regular round. So a lot of these companies are kind of stuck. The smarter one kind of trying to extend their runway and kind of grow into valuation. Sometimes you can, sometimes you can't. But I think in the next 6 to 9 months, we'll see a lot of blood on the streets. We'll see a lot of these companies either got acquired as like acqui-hires or closing. Some of them will go for like really down rounds. I already see down rounds. Just a week ago, I saw the company which raised money at 100 million post-money valuation last round, and now they're trying to raise at 15 to 20, which is going to completely wipe out all the common and early stage investors. And they haven't found the lead. The company is, frankly, it's a reasonable product. We have some reasonable traction for kind of late seed, early A, but we just got screwed because we took way too much money. The other problem with taking way too much money, it's very hard if you raise 15 million seed round, it's very hard not to spend all this money. So these companies get used to being very, very capital inefficient. They have huge burns, and when we need to extend their runway, we're starting to cut their burn rate, but we not getting even close to the reasonable burn rate for their stage. So in many cases, when you look at these companies, nowadays people look a lot at capital efficiency metrics. You look at a company which is basically late seed, initial below 1 million ARR, and the company is burning like 600K a month, which doesn't make any sense.
Yeah, no,
and
absolutely.
It's very hard. Like we have to scale back to like we basically have to fire like 80% of their current employees to get to like really correct size company for their stage, which is very, very, very hard to do and very bad for morale.
Yeah, no, absolutely right. I think there's going to be a lot of bloodbath, but lot of lessons for founders who are going to start right now. I think the lessons have been learned by the VCs as well as from the founders. But what advice would you give to emerging managers, trying to raise their first and second funds? Obviously, they're struggling, but any advice for them?
So I wouldn't give advice on how to raise your funds. We're still in kind of learning mode ourselves. We're on a third fund now,
right.
But we're still learning how to properly raise the venture fund. But it's actually it's a good timing because the market is correcting. So whoever is going to be investing in the next year, there's a good chance we're going to get into like really good companies, and it's the best time to invest when there is blood on the streets. So I think they need to be, especially like first-time managers, we need to be cautious not to kind of jump too quickly on a deal.
Right.
We need to do their homework, but I think there will be a lot of really good deals on the market in the next year. So it's a good timing if you're on the first or second fund. If you have money to invest, it's really good.
Correct. Interesting. You've been in the venture industry for close to a decade now, and there have been a lot of innovative products like crowdfunding campaigns and a lot of interesting things have come, especially with AI. It hasn't really disrupted the venture industry, but it has really helped and increase the productivity by say 30%. But who do you think will be the winners and losers in the next 10 years of the venture capital, especially in the venture industry?
So one thing, venture industry is the industry with really, really long feedback loop. Especially if you invest in early stage, you understand how your fund is doing probably closer to the year 5 of your fund. Because before that, it's still hard to say. When we were on like year 5 on our first fund, we kind of usually when we meet, we have this like 5 top companies in the portfolio, kind of spending a little bit more time on these companies. So the funny thing, when we look at top 5 companies, when we were on year like 4, out of top 5 companies, I think 3 companies are no longer top performers in our fund. So our top 5 companies in the portfolio 4 years ago were mostly different from whatever it's now. It takes, especially if you do early stage, it takes you probably 5 to 7 years to understand who are the winners and who are the losers. Like you have a lot of these companies which are kind of good companies, you invest in it, and in 5-6 years you get exit, and you have like maybe 3-4x on your money, but it's not gonna move the needle for the whole fund. The real winners, which are kind of fund returning companies, it takes like 7 years to get there. You can't really build unicorn in like 2-3 years.
Yeah.
Unless it's like a bubble, but most of these unicorns which become unicorns way too quickly, they at the end they unbecome unicorns even quicker. So whoever are winners in 10 years, it means these funds are probably going to invest in their winning company like in the next 3 years, I would say. And it's very hard to say. It's a lot of this, it's luck, meeting the right founder at the right time. And another thing what I learned, what a lot of our winning companies, when we just looked at them for the first time, it wasn't a clear-cut investment. Actually, when the investment is kind of clear-cut, it's a good company, everything is well, everything is nice. At early stage, doesn't mean much. They may be good companies, but they're not like the ones are real winners, a little bit crazy, a little bit problematic. So a lot of this it's luck, a lot of this it's being there for them and helping them, but it's very hard to predict who will be winners. Also in venture world, if you already have a brand as a VC fund, it's a huge advantage. Because if you already have a brand, if you just starting your new fund, if you just first or second fund, it's very hard to compete with brand names. So it takes a lot of time. It takes probably 2-3 plus funds to get to this stage when you have a brand name, when people know you're successful and you can help portfolio companies, and then you start getting really good deals. So 10 years, in venture, it's pretty short term, and I think it's hard to say. I'm pretty sure we'll see some usual suspects there, and at the same time we'll see a lot of new names too.
Got it. So interesting. And so I quickly want to do the top 3. What's your favorite business book?
I have several books, but like one which comes to mind, I really love Chris Voss, Never Split the Difference. It's a book on negotiation. Love it. And actually, I think at least a quarter of my founders, I basically just at some point said, okay, here is the book, you have to read it. And make sure you read it before your like next quarter or whatever.
Right. Correct. And if you could go back in time when you started your career in venture capital and you started with Flint Capital, or what is one thing you would have focused on or done anything differently?
I think the main thing is it's all about people. Especially when we started, we would look at the company and we would, especially when we're talking about early stage, we would try to analyze to the depth competitive landscape, market, and all this stuff, and probably spend a little bit less time when we shoot on the team. Nowadays, we understand what's 90% of the success when we're talking about early stage, it's actual team.
Yeah. Got it. And do you have any favorite online tool, for example, Gmail, Slack, Zoom?
I wouldn't say it's like specific online tool, but the tech stack I'm using, it's pretty standard. We use a lot of tools from Google, talking about like email, calendar, other things. I love Calendly because it saved me a lot of time. We don't have executive assistants in our fund. Everybody is doing their own kind of scheduling, etc., and it saves you a lot of time when you can send. And frankly, when people send me Calendly link, it's just easier when talking to somebody. Usually saves a lot of time. We use Affinity as CRM, but most of the stuff is pretty standard. I wouldn't say we have specific tool which we're using, which is like, wow.
Yeah. Yeah, no, absolutely. I think I can't do without Calendly and Zoom. I think these two products run my podcast.
Zoom is the main, and especially for us because we have all the team is remote. So we actually, it's funny. In 2020, everybody was complaining what we can't really invest over Zoom. And for us, it was business as usual. We were always investing over Zoom because the team is completely distributed. So every time we talk to founders, we try at least one partner physically meet with founders, but not always. But we almost never had an investment where all partners actually physically were able to meet with founding team because it's just way too complicated. So yeah, Zoom. And I do use a lot nowadays ChatGPT, but that would be like everybody is using it for all kind of different things. We're trying to figure out, we're looking at different tools with AI relatively to like helping us with like all kind of reach out and things like that, but we're still kind of learning all this stuff.
Yeah, no, absolutely. I think ChatGPT is like one of the best finds of last year. And Sergey, what are the best way people can reach out to you and know more about Flint Capital?
So it's easy to find me online. Our site is flintcap.com. My email is sg@flintcap.com. I usually try to answer. It's not always possible because I'm getting like several hundred emails a day. So sometimes it would take me even months to answer because usually I fly a lot. I usually travel to Israel every couple of months. So usually my typical routine is every time I'm on a transatlantic flight, I usually try to go through my emails and answer all these emails which you had no chance to answer in the last like couple of months. But
yeah, no,
it's like.
Yeah, no, I can totally understand. But we'll put that in the show notes. Sergey, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Thank you for inviting me. It was really fun.